In the energy quadrant, taking a look at the December crude oil futures, which had a big gap this morning. Crude oil gap lower by 3.9% and did not move much higher from that gap. The high today, 69 even, was down 3.87% from Friday's settlement of 71.78. The open was down 3.9% from Friday's settlement. So we had virtually a straight down move other than those 2 or 3 basis points difference between the opening gap lower and the gap from the high. The low today, 66.92, down 6.77%, taking us to the lowest absolute price level since the spike low on October 1st. Yes, we are rallying a little bit off the bottom right now, but not enough to take crude oil from the low end of its range to anywhere near positive in terms of short-term trend. As we get in toward the close, a little bit of time left, we're still down around 5.5%, still in that $67 handle. Geopolitics is the reason for this. We had a geopolitical flare-up over the weekend, but it was not a direct, it wasn't related to the supply of crude oil coming onto the market. There was no disruption in the supply of crude oil from this particular flare-up. And that's what the market was afraid of. That's likely why we saw a few days of rallies last week that kind of sustained, as markets might have been expecting this, but markets definitely expected disruption in supply, and that did not happen. Still could happen in the future, but not being priced in as I speak to you right now. And also, U.S. yields are rising today, but they're not pushing the dollar into positive territory. So that's definitely, when you get the stronger yields, you are looking for a stronger dollar, which tends to be inversely related to crude oil prices. So while the dollar isn't reacting yet, the yields continue to rise and are likely to make the dollar stronger again, pushing crude oil prices down if their typical inverse relationship holds up.